Hello everyone and welcome to this video in the Learn Technical Analysis series brought to you by thetechnicals.com. Today we're talking about one of the most basic but also among the most important aspects of technical analysis, support and resistance. But before we get to that, as always, just a quick risk disclaimer. Trading in the financial markets carries a high level of risk and may not be suitable for all investors. Before deciding to trade in the financial markets, you should carefully consider your investment objectives, level of experience, and risk appetite. Okay, let's get started real quick. Now, what exactly are support and resistance? Well, support is a price floor where more demand in the market may be expected. Resistance is a price ceiling where more supply in the market may be expected. The conventional wisdom is to buy at or near support and sell at or near resistance. This is, of course, unless there is some type of a breakout that breaks the support or the resistance levels. Support and resistance are derived primarily from past turning points in price. Two or more turns at or around the same price level can create a key support and resistance level, at which point you could draw a horizontal line to denote that support or resistance. Now, significant price events tend to occur around established support and resistance levels, and this includes bounces or breakouts of those levels. Support and resistance exist because of market memory. Traders and market participants remember specific price levels as being relatively high, as in resistance, or relatively low, as in support. What we like to do is use support and resistance as potential entry zones. We're looking for support or resistance bounces or respect, or support or resistance breakouts or violations to use in this capacity. Now, other methods of denoting support and resistance besides prior turning points in price include Fibonacci levels, pivot points, trend lines, moving averages, and others. Here are some examples of support and resistance. As we can see here, we see that support is a floor until broken. So we see a bounce right here, then here again, then here again, and then finally this support is broken to the downside and price follows through to the downside from there. So that is support as a floor until broken. Now, resistance is simply a ceiling until broken. So as we can see here with this line right here, we have a ceiling in price right here, and then a break to the downside, and then another ceiling in price is established, etc. Okay, so let's take a look at some real chart examples. As we can see here, we have a chart. This is a daily chart of the pound dollar. Let me go ahead and draw a resistance line like so. Okay, we see one touch there, another touch there, another touch there. It overshot a little bit up there, but then came down and acted as resistance, as we can see, a ceiling. And I could draw support to the downside right here. We have support touches over here, and then a break to the downside that breaks that support, that breaks the floor. Let's take another example here. This is the Aussie dollar chart, and I'll go ahead and draw resistance, as we can see here. And then we could just as easily draw support right around here. Support and resistance are among the most important technical tools available for finding high probability opportunities to buy or sell in the financial markets. Please visit thetechnicals.com for more trading and technical analysis education. Thank you very much.